The rise of the digital economy has revolutionized industries and global markets, offering unprecedented growth opportunities while presenting significant taxation challenges. Traditional tax systems, which rely on a company's physical presence to establish tax obligations, have struggled to adapt to the borderless nature of digital businesses. Digital companies can operate in multiple countries without a physical footprint, allowing them to shift profits to low-tax jurisdictions, minimizing their tax liabilities in places where their services are consumed. This leads to a substantial loss of tax revenue for many countries. One of the key issues is the concept of nexus, which refers to the legal connection needed for a country to tax a company. In the digital economy, many businesses do not meet the traditional physical presence requirement, complicating efforts to tax them. Valuing digital goods and services, often exchanged for data instead of money, further complicates the taxation process. The rapid pace of digital innovation has also outstripped regulatory systems, allowing businesses to exploit gaps for tax avoidance. On the positive side, digital technologies offer new ways to streamline tax collection. For example, digital payment platforms could facilitate automatic tax collection at the point of sale, while blockchain could enable secure, transparent tax transactions, reducing evasion. Tackling the global nature of the digital economy requires collaborative international solutions. The Organization for Economic Cooperation and Development, OECD, has spearheaded efforts to reform global tax rules, suggesting that profits should be taxed where economic value is created, regardless of where companies choose to book their profits. This includes proposals to grant new taxing rights based on user and consumer locations, even if the company lacks a physical presence in those markets. There is also growing support for a global minimum corporate tax rate, aimed at preventing countries from engaging in a race to the bottom by lowering tax rates to attract multinational companies. Looking to the future, taxation in the digital economy will focus on closing loopholes, enhancing international cooperation, and adopting digital tools for tax collection. Greater transparency and information sharing among tax authorities will be essential for tracking cross-border digital transactions and profits. Engaging the public and educating stakeholders on the changing tax landscape will be critical to ensuring compliance and fairness. The digital economy poses complex challenges for tax systems, but with innovative policies, global cooperation, and technological advancements, countries can create a more equitable, transparent, and efficient tax framework for the digital age. The ultimate goal is to ensure that digital businesses contribute their fair share to the funding of public services and infrastructure, just as traditional businesses do. One approach to address this is the implementation of digital services taxes, DSTs, which target digital activities like online advertising and streaming. Countries such as France, Italy, and Spain have introduced DSTs to ensure that tech giants, despite their minimal physical presence, contribute to public revenues. DSTs face criticism for potentially causing double taxation and international tensions, especially with the United States, where many tech companies are headquartered. The Organization for Economic Cooperation and Development, OECD, has proposed a two-pillar solution, focusing on reallocating taxing rights and setting a global minimum tax to ensure fairness and prevent a race to the bottom in corporate taxation. Countries are turning to value-added tax, VAT, or goods and services tax, GST, on e-commerce transactions, as seen in the European Union, to ensure that digital goods and services are taxed where consumers are based. Looking forward, the key to effective digital taxation lies in balancing innovation and fairness. Adaptive tax policies, international cooperation, and an emphasis on equity will be essential to fostering sustainable growth in the digital economy. As digital technologies evolve, tax systems must keep pace, ensuring that global commerce remains both innovative and fiscally responsible. The integration of big data and artificial intelligence, AI, into tax administration is revolutionizing the way governments manage fiscal policy. These technologies offer unprecedented capabilities to analyze vast amounts of data, improving tax compliance, enforcement, and taxpayer services. Big data provides insights into taxpayer behavior and economic trends, while AI enables real-time analysis to detect fraud, evasion, and non-compliance. One key impact is the enhancement of enforcement efforts. AI can quickly identify suspicious patterns in financial transactions, allowing tax authorities to focus on high-risk areas. This improves the efficiency and accuracy of enforcement, reducing tax evasion and increasing revenue collection. Beyond enforcement, big data and AI also improve taxpayer services. AI-powered tools like virtual assistants and chatbots make tax filing easier and more personalized, encouraging voluntary compliance. Predictive analytics help taxpayers with tailored advice on tax planning and obligations, enhancing their overall experience. The emergence of cryptocurrencies and blockchain technology is revolutionizing finance, presenting both opportunities and challenges, particularly in taxation. Cryptocurrencies like Bitcoin, built on decentralized blockchain systems, have surged in popularity, but their unique attributes complicate traditional tax frameworks. A key challenge is classification. Cryptocurrencies blur the lines between currency, property, and commodities, leading to varying tax treatments across jurisdictions, such as capital gains or income tax. The decentralized nature of blockchain further complicates matters since it lacks central reporting authorities like banks, making it difficult for tax authorities to trace and verify transactions. Valuation adds another layer of complexity due to cryptocurrency's high volatility, making it challenging to assess tax liabilities accurately. Determining fair market value for tax purposes is especially difficult without standardized valuation methods. As technology advances, tax authorities must adapt their policies to keep pace. The shift to decentralized digital assets challenges traditional taxation principles based on physical presence and source income, requiring new approaches that reflect the realities of a global digital economy. Cryptocurrencies and blockchain represent a pivotal moment in financial history, prompting a rethinking of tax systems. With innovation, international collaboration, and adaptive policies, tax authorities can shape a fair and efficient system for the digital age.